Life is not about finding yourself, it's about creating yourself. So live the life you imagine. Hello everyone, this is me Vibek Paudyal, your host. Welcome to my book summary studio. Before diving into today's episode, as a bonus for listening to my summary, you have access to the PDF version of this book summary. The link is in the description below. In this podcast, I am taking the most important notes as a summary within 5 to 10 minutes so that you are saving some bucks of money as well as your precious time too. Please make sure that you have subscribed to the podcast however you are listening to me, and do not forget to share it with your friends so that they will also take the benefit of it. Without delay, let's get it started. Today, I am bringing you a great book, The Classic Text on Value Investing, written by the father of value investing, Benjamin Graham. This book, Graham's classic bestseller on value investing, has taught and inspired hundreds of thousands of people worldwide. Graham offers the investing principles as he originally laid them out, principles that continue to stand more than half a century since the book was first published. Who was the professor and mentor of Warren Buffett? You probably know that I have already made a summary of Warren Buffett's great book, The Essays of Warren Buffett, written by Lawrence A. Cunningham. If not, please check my video list where you will find the summary. Okay, now let's move into the main keynote suggested by Benjamin Graham. First, what do you mean by investor? An investment operation is one which, upon through analysis, promises safety of principal and a satisfactory return. Operations not meeting these requirements are speculative, meaning investor is a profit maker, not loser, and not done by luck, achieved by required analysis and precise formulation. Second, the word intelligent doesn't mean smart or gifted with unusual foresight or insight. It means endowed with the capacity for knowledge and understanding. Actually, intelligence here is supposed as a trait more of character than of the brain. In this way, the Graham defines for intelligent investors. He says that if we look out for characteristics of investors in the world, we can get two types of investors. First, the defensive or the conservative, and second, the aggressive or enterprising investor. The defensive investors are those who don't want to take more risk and knowledge, but they are very interested to understand general terms about their money, results, and why questions. They throw the major burden of their investment operations to the shoulder of others. Meanwhile, the aggressive or enterprising investors are willing to devote time and take care of the selection of attractive investment. It is not suggested by that the enterprising investor must be a fully trained expert in the field. He may well derive his information and ideas from others, particularly from security analysts, but the decisions are his own. Now, it may be useful to summarize the kind of investment which we have found to be suitable for our two classes of investors. Here is the list that defensive investors and enterprising investors will buy. The number A, the defensive investor will buy: number 1, United States saving bonds; number 2, a diversified list of common stocks at a reasonable price. If you would like to know how to find a reasonable price, then you must watch my previous video. The link is in the description below. And the number 3 is the shares of leading investment funds. Now, the enterprising investor will buy: number 1, all of defensive investor will buy; number 2, growth stocks but with caution; number 3, common stocks when the general market is historically low; number 4, secondary common stocks, corporate bonds at bargain levels. This way they will make the selection of their portfolio. Here, Graham suggests for a value approach before buying. Remember this: buy during periods of pessimism and low prices, sell during periods of optimism and high prices, as Warren Buffett suggested in his essays, right? So now let's take a look at the portfolio policy of these investors. The rate of return is dependent on the amount of intelligent effort the investor is willing and able to bear in his tasks. The minimum return goes for our defensive investor who wants both safety and freedom from concern. The maximum return goes to enterprising investors who exercise maximum intelligence and skill. We have already outlined the portfolio policy of defensive investors. He should divide his funds between high-grade bonds and high-grade common stocks, right? So 25% of his money should invest in high-grade bonds and 75% of his money should invest in high-grade common stocks. Meanwhile, the aggressive investor also should start from the same base as the defensive investor, namely a division of his funds between United States saving bonds and high-grade common stocks, but bought at a reasonable price. Always must remember. Also, these 4 special characters makes him different than others, and these are the number 1, buying in low markets and selling in high markets, meaning taking the opportunity when the Mr. Market is very down, buy when others are selling, and sell when others are buying. That's the intelligence. Number 2, buying carefully chosen growth stocks. You may be thinking, if the market is down, how it could be growth stock, right? But the answer is yes. Market down doesn't mean that the company or the business is not going well. Mostly the price of the stocks is fluctuated by Mr. Market, which does not affect the main value of the company or real price of stocks. Ups and downs mostly happens in the market. Number 3, buying bargain issues of various types. And the number 4, buying into special situations, meaning a particular kind of undervalued security in which the profit is expected to be realized from a definite corporate events. Such events include sale of a business, merger, recapitalization, reorganization, and liquidation. So, except for these characteristics, the aggressive investors should obtain the best available estimates of what a number of stocks are worth apart from their market price. While saying this, we must look at the future earning power too. This way, you can create your investment portfolio for your future according to your interest and willingness. Here are a few principles and points to remember suggested by Benjamin Graham. So the number 1, do not miss the undervalued issues. Sometimes in the market, the business is undervalued so that its market price gets down, but the business keeps growing. The number 2, margin of safety. Margin of safety is there when the business is undervalued, so that you can make a good profit even in a short period of time and you are in a safe place. Number 3, buying high-grade common stocks with high prices is not a good investment. Buying high-grade common stocks with cheap prices is an intelligent investment. Number 4, do not do those things which you don't know what you are doing. Do not buy those stocks if you don't know the simple basic information about the business on which you are interested in. Number 5, chief losses to investors come from the purchase of low-quality securities at times of favorable business conditions. Means right time for investing, but the bad selection of the securities, right? Number 6, if you don't like the management, sell your stocks. The quality of management is the most important consideration in selecting an investment. The future of the business is in the control of the management team where you are going to invest in, right? This is how I summarize this book. I hope that you learned a lot about value investing in an intelligent way. Thank you for listening. Thank you for listening to this episode. I hope that you get the whole summary of this book and enjoy it. Don't forget to leave feedback and comments so that we can bring you the best version of ourselves. I'm leaving you now with my first podcast and see you in the next episode with another great book summary. Make every single day better. Make somebody's day happier. Bye-bye.